So let's do the stock market update. You all wait for this and you all absolutely love it. I know. So let's get on with it. Here we go. First things first. Those things that you see on screen over there are the price earnings ratios, the valuations. And yet again, another week where the banks and the energy companies are really the only ones which on that particular measure of valuation, which is the share price relative to the profitability per share of a company, are undervalued. What about performance? Well, another week where the market's all risen. So not bad at all. Some of the strongest areas are the consumer defensives, particularly the likes of the discount stores like Walmart, Costco, which also happen to be more of my favorites. They've got the sort of brightest green, as it were, and the ones which have risen the most, and obviously some of the energy companies. What about another measure of valuation? Having already looked at price earnings and also looked at momentum, let's look at a completely different measure of valuation, which is the price earnings growth ratio. A figure under 1 means the company's undervalued. Well, here we've got oil and gas yet again, pretty much the only undervalued sector. Let's have a look at the S&P. Option 2, most likely, I think, is we go along here. Option 3, if you're risk averse and pessimistic, you think the market's going to pull back and will end up falling. And of course, if you're optimistic, you think it continues on this V shape that it's done so far. We've done quite a rebound here. Now, here's what's interesting. That red line is arguably a resistance, and the market's met it. So if it breaks above it, then I'd be more optimistic. If it continues just dangling along this way, then you see why I'm thinking option 2 is the most likely. On the MACD monthly and weekly, and the stochastics monthly and weekly, what I can see there is, yes, yet again, a base forming. If you're risk loving, you get in. If you're risk averse, you stay in cash. Apple, you can see again a sharp V-shape move up. And if you're risk loving, you do 2 times Apple leveraged. If you're risk averse, you hold cash in the bank and wait till one of my other updates. Microsoft, same story. Sharp rebound, risk, and each of these B's is where an investment bank is giving it a buy rating. Okay, if you're risk loving, you do 2 times Microsoft leverage, ETFs or CFDs, and if you're risk averse, you keep holding cash. Similar story with Amazon. Okay, you can see it over there, and I've projected the kinds of returns that I was anticipating, 65% from the lows. From these levels, it's probably half that now because it's already done halfway there sooner than I thought it would. Meta, well, that's one which is still in line with what I thought it would do, which is just trace this green line. So you're waiting a long time for that one to give you anything, as things stand, to give a better return. So that one, if you're risk averse, you'd probably just completely stay. Even if you're risk loving, you'd stay away from. Costco, as you saw, and I'd already mentioned one of my favorites. Well, it dropped 27% peak to trough, but I'd projected in 6 months a 52% return. It seems to have done that in almost a month. PayPal, image says it all. How much it's fallen, the direction I think it'll continue in. Not much more to add there. Westlake, it's forming a bit of a base, starting to rise. This is just to give you a bit of a flavor for other companies. Qualcomm, it's been in the news a bit, just in terms of what hedge funds seem to like. It's formed a bit of a base. Johnson & Johnson, I've given some projections, nothing exciting in a year, probably about an 8% return, I'm afraid, in that one. But people hold it because they don't want to lose their money and they want to get a dividend. So they're happy with 8% capital gain plus a few percentage points on yields. That's why they'd hold a Johnson & Johnson, but we want more than that. Katera Energy, on the energy side, you can see the trend and the direction of that. Marathon Oil, similar kind of story. Okay, sorry, Halliburton and then Marathon Oil. Occidental, Warren Buffett. Well, since I said at that point it will probably go in this direction, which is why Buffett's bought it, and it's up, I expect it to be up 37% in a year, as opposed to falling, which is what it could have done, but it hasn't. I hold my forecast that I think it'll continue doing that. Okay, along that line. That's where we are with it. Devon Energy, the green line marks which direction I think it's going in and the rate of growth. Marathon Petroleum, green line marks where I think it's going and the rate of growth. All right. A lot more to come. We're only halfway through it. Have a look at my campaign for $1million.com to teach 1 million people how to be better investors. Now, Michael Burry, the big short. NASDAQ up 23%. He thinks it's going to fall. He thinks this is a bear market rally. Interestingly, he thinks something can go up 50% before it falls back. In my book, it goes up 50%. I'm all right, mate. Thanks a lot. I'll take that and then leave. Okay. S&P, as I showed already, a slightly clearer image there and the direction I think we're going with that one and where we are. All right. Catalyst Pharmaceutical Partners, 65% undervalued on my approved filtered list. That's what it looks like. Would you want to get in? It's sort of gone shot up by now. And so I can see why people would say, oh, I think it's gone up too much, Alpesh. No thanks. Fair enough. Alliance Resources, 68% undervalued, approved filtered list. That's what it looks like. It's wonderful. You know, just straight upward trend with low volatility. What the heck? Of course, that could be the kiss of death now as it peaks near its all-time, well, sorry, near its, what is that, 7-year highs and then goes down again. But I just want to give those two as examples on my approved filtered list and undervalued. Let's look at inflation. That's where we are compared to the post-war era. Not nice. We're in one of those bad high inflation periods. Why is that bad? Well, here are some numbers. If you've got 9% inflation, then after 8 years, you've halved your purchasing power. So what will protect us? US home prices? Not really. There are prolonged periods from 1990 to 2000 where you did under 5% real return. Okay? From, what's that, 2008 to 2020, you did under 5%. So you didn't beat inflation. Gold, too many reds there as well for prolonged periods of time. Stocks, a little bit better. Usually better. Down here where we are, 2022 to 2022, we're not beating inflation at the moment, but given all these blues in the past, we should expect to, especially if we're holding for a longer period of time. What do you do? Here's a good flow chart. Cash, if you're risk averse, you wait a month or you average in. If you're risk loving, you get in, but I'd suggest you look at stocks on my approved filtered list. Volatility under 20%, S&P 500 and quality companies. Email me if you don't know what my approved filtered list is. Bear market rallies, returns versus duration. This is where we are, days until the top of the rally. Size of the rally. So we could continue going up along here and easily get to here, but that's less likely. So you'll notice most of these things top out around now. So we might not have much further to go in the rally before we hit the top of it and then fall back, which is what Morgan Stanley say will happen. So on the trading side with pipspredator, these are the kinds of trades we'll be keeping an eye on. Canadian dollar, Japanese yen, smooth trends in US dollar, Canadian dollar. And on Bitcoin, rather smooth trends. You can see it there. Nice smooth trend. So we're waiting for the next signal on that. That's the 30-minute bars. Beating inflation S&P 500. The periods when it's done it. Again, that case for investing in the S&P, it's done it for most of its life. Okay, blue means it's exceeded inflation by over 5% in those periods. And red means it hadn't. Where are we at the moment? 4 weeks of upward moves. That's a good winning streak. It's not had one since October of last year. But what does that mean? Well, it means the streak's probably over, my friends. And that leads us on to Mr. Morgan. That's Mr. Morgan Stanley, who believes markets will fall, whereas Mr. Morgan of JP Morgan believes they will rally. Not much use then. Michael Burry, who's a pessimist, owns those stocks. So this is what a pessimist owns. Somebody who thinks the market's going to fall. And this is what a long-term optimist holds. I own Occidental. I own Apple. Those are the only two I own out of those. The risk of disappointing earnings is one reason we're tactically underweight stocks, said Morgan Stanley. Well, said BlackRock, said BlackRock. They're worried about profitability and maybe supply side costs, wage costs, not getting things onto the shelves and therefore hitting profits. That's what they're worried about. Let's look at the macroeconomic scenario. This is government debt to GDP. My wife asked me, are there any countries not in debt? And I said, yeah, loads. There they are. They're the ones. The Japanese have the worst debt to GDP, though it's the third largest economy in the world, and they buy lots of US debt. So they lend money to the Americans as well. Okay, so that's where we are on debt to GDP. You want to stay away from the really red ones. I mean, Japan worries me. Property companies. This is Persimmon. Has it been overdone? Whoops. Has it been overdone? Look at how much it's fallen since 2021. Have we overshot? Because in the past, when we've gone there, it's managed to bounce back up again. Food for thought. I'll come back to those later on. Keep an eye on my Telegram channel. The link's in the bio. All the free information I have on campaignforamillion.com. Thank you all very much. Oh, like and follow and do all those other social media things if you would, please. And share with friends and let them know of my existence.